Bob, very good to see you from afar.
Thank you so much, Howard.
Yeah, we wish if they only knew where you were, they would all wish that they were there. So
You're
you
welcome anytime.
Don't rub it in. It's 98 degrees here and miserable. So
Well, if the temperature gets above 74, I call the realtor. I want to sell my house. So you sort of have my sympathy.
so we have Bob, Andy Fisch, and the great Suzanne Murphy. And I actually decided that I have to coin a phrase, which is SST, which is Cicada Standard Time. That that'll keep us going. So I still believe in chivalry. So we're gonna go Suzanne, Bob, and Andy to introduce yourselves, and then we'll get going.
hi, I'm Suzanne Murphy. I've been. Can you hear? Can everyone hear me? Okay, couldn't tell if it was on. I'm Suzanne Murphy. I've been in the alternative space for longer than I care to admit. Started my career on the sell side, and then moved over to the dark side. I've spent a lot of that time in the credit space. I was at a hedge fund called Claren Road, which we sold to Carlyle 15 years ago. Hard to believe. And then have done a lot of consulting work in the space and now work with a group that had a fund, then became a family office and wants to raise a fund again in the lower middle market special sit space, credit and equity, but mostly credit. That's the background. And I also, because of the luck of the sale of Claren Road, had a liquidity event, and so have my own family office. But in full disclosure, Jeff Asaf, who was here this morning, is our outsourced CIO.
Bob,
Thank you, Howard. I'm Bob Zadek. I practice law in San Diego. Actually, I live in Coronado, and I work from home. Compliments of COVID. I'm pretending COVID is still around, and therefore I don't have to go to an office. So here I am. I've been doing secured lending, middle market secured lending, since June 5th, 1962, in one form or another. Yes, I didn't make there wasn't a typographical error. That's correct. Uh, I'm in, I'm an attorney, practicing attorney, still working 7 days a week, doing loan transactions in the middle market. One-off credits, one borrower, one lender, tons of collateral. That's my world. In 2000, I I realized I was living in a world of gross injustice. There was something that was very unfair, and I couldn't explain it, even though I'm a free marketeer. And it was, how come, since I was so much smarter than any of my creditor clients, they were so much more wealthy than I was? It was the market wasn't behaving the way it's supposed to. And I realized I'm selling hours, which are limited, and they're making loans, which is unlimited except by capital. So I became a lender as well to correct that great injustice in the world. And in addition to practicing law, I've been in the world of middle market secured lending as a lender. And I've been doing that. This is my 26th year in the middle market. Secured lending, collateral is king. That's what I understand. And uh, the reason I'm here, I guess, is to help this group have a bit of an understanding of the very strange world of middle market secured lending. I say strange because the yields are too high for the risk if you do it right. And it's a area of employment of funds. We are talking about only earning income. We're not talking about capital appreciation. We're talking about return on money, liquidity, return on money, and most importantly, you don't have to manage anything. If you have collateral, the externalities in the world don't matter all that much. That's the beauty of secured lending. As our panel continues, I'll explain what I mean, but that'll be sufficient for the moment.
Andy.
So I'll admit this is my 41st year as a buy-side investor. 20 years in captive capital and family office world. I started out trading commodities futures and options. Then I ran a long short equity fund, and that led to running 3 venture capital funds. So my life then 20 years in did a 180, and I was brought in to build and run State Street's global fund of hedge funds, which I did for 15 years. One of those fund of hedge funds was a credit fund of fund, and we also built, which didn't fit in a fund of fund, we built portfolios of specialty finance. The portfolio started in 2012, but if you go all the way back, I did The Big Short, like the movie without the drama. There wasn't a lot of drama. It's just headaches.
I was invested with the guy in California at the time.
Oh, really? No, I did it with John Paulson. Anyway, I was also invested in Claren Road. We knew each other before that, actually. So I'm sorry, I'm dating her. So
She looks much younger.
she looks the same, actually, exactly the same. And
I've had some help.
so the credit fund
Cloning.
was a global portfolio, and that included everything from Asia, Europe, US, included public securities and more private ones, and all kinds of instruments, derivatives, et cetera, et cetera. And the private credit portfolio, I mean, I think people have already brought up enough. So I went back to family office investing 9 years ago. And essentially, one side of it is income generating, the other side is growth, I suppose.
Okay, and my name is Howard Cohen, and I work with high net worth individuals, families, and business owners and family offices. And primarily, we utilize unique tools and techniques to create tax-favored succession and exit strategies. Happy to talk to anybody about that. Anyway, so here we are, and so I got to have conversations with all 3 of you over the last few days, and one of the areas that, Suzanne, that you brought up immediately was the Fed and how the action or inaction of the Fed is affecting what's going on with credit investment strategies.
So the Fed is interesting right now because Powell is holding firm. And so we are, as an investment firm in the camp of higher for longer. I mean, there are 2 dissenters on the Fed board. Where that goes, I mean, my instinct is that Trump is not going to be able to bully Powell into changing things for the moment. And it's an interesting dichotomy, right? Because for big companies that have cash or have ready access to capital, the higher rates don't matter that much. And for those of us who've lived long enough, I mean, these rates still aren't that high. I mean, I'm glad I have my 2.5% mortgage, but in my father's day, my father never had a mortgage. He was always proud of saying that, but it could have been 17%. So 7% doesn't seem so bad. For smaller companies, it's created a real problem because they don't have cash on the balance sheet. So the larger companies that do are obviously getting a tailwind. The ones who need access to capital haven't and have the ability to pay these rates because they're not that egregious. But the smaller companies don't have access to that capital. They don't generally have excess cash. They typically have borrowed from the regional banks, which we now know are completely hamstrung. And the private lenders who work with them, it's even more expensive than these Fed fund rates. And it makes it harder for smaller operators to continue to operate and build their businesses. So, I think it's a dichotomous world, but we certainly are in the camp of higher for longer. It's funny, I meant to ask Jeff Asaph that question this morning, and we just didn't get to it. But we'll see. But I think Powell's going to hold firm, and I don't see the economy slowing enough as to where the Fed would or should lower rates again.
So
I think all the liquidity hurt us.
well, your 2% mortgage is not normal. in
It's
my life.
Totally not.
A 17% mortgage is not normal, but
It's
it's,
2.5,
but
by the way.
oh, sorry, don't sell that place. But a 7% mortgage is normal.
After yesterday, I'm
Okay.
not going to be able to sell it.
The 7% mortgage is based on a 4.35% 10-year bond. The Fed isn't playing with that. And let me give you a different Fed perspective.
Well, they
sir.
don't have control
So
over the 10-year.
That's exactly my point. So you're looking at Fed funds rate, which only affects certain circles of credit. But let me talk about the part where Suzanne was talking about big companies, small companies, and the Fed. Because the part nobody talks about is the Fed's balance sheet. So what happened when you got those 2% mortgages, the Fed took their balance sheet from $1 trillion to $4.5 trillion to, in the pandemic, to $9 trillion. So what that is doing is, what does that mean? They're buying bonds. They are soaking up bonds and adding liquidity to the system. So those small companies, mid companies, big companies, good companies, bad companies, all could get financing because lots of liquidity in the system, and that flowed all the way through to all types of credit. Now what's happening is the Fed has taken the balance sheet from, now they might not have raised Fed funds rates, but they've taken the balance sheet from $9 trillion to $7 trillion, and that is sucking credit availability out of the system. So Suzanne's correct. It points to well, Apple doesn't even need to borrow money, but even big companies that do, we've not seen an increase in defaults. We've not seen an increase to the cost of credit. If you go to the high yield market and just look at an ETF, they were yielding like 5.5%. I worked for State Street for 15 years. JNK is their high yield ETF. I had nothing to do with ETFs, by the way. I ran a fund of funds, the opposite. But my point is that portfolio is a proxy for high yield, 5.5%. Beginning in the first quarter of 23, when high yield started being reissued again, remember we had the pandemic, we had inflation, there was no issuance for a while. They were issuing at 8.5%. So those companies that Suzanne's talking about that had to refi, their cost of servicing their debt went up almost 50%.
While at the same time, the supply chain is more expensive. There's
Yeah, I was just
inflation.
trying to
Right.
just
No, I
keep it
understand.
in a circle though of how the Fed indirectly affects the credit markets and the credit availability and the cost of credit. So I just wanted to keep it in that, in that circle.
Howard,
But to Suzanne's point, there's this knock-on effect of the Fed, and it has a lot less to do with the Fed funds rate. Because as we
Howard,
just discussed, the 10-year, they have no control over, unless they have gone out and bought 10-year bonds. The 10-year got down to 1.35%, which is bizarre. And it's only because the Fed was buying them. But they're not anymore. In fact, they're letting them run off. And so my view of rates, other than the Fed funds rate, we can leave that aside, it's pretty normal for my career. 4%, 7% mortgages, 8.5%, 5% high yield is dumb.
Yeah, but remember, most of the people that are in the business today don't remember what we
Well,
remember.
They have 2.5% mortgages and they think that's normal, but it's not.
Bob,
Howard.
how,
Yeah,
how is this affecting your lending?
well, it's quite interesting, but in secured lending, remember, I am a secured lender. In a secured lender, externalities almost universally don't matter or are good news. So the beauty, and by the way, any family office attending this program can, in about 48 hours, access this marketplace. And the exit is equally easy. It's a very liquid marketplace, the marketplace for non-bank lending. Now, the reason these externalities don't matter, and that's important that they don't matter, because it's one less thing I have to worry about. Number one, most lenders' borrowing costs is related to prime, and our lending cost is related to prime. So in the short run, the P&L is not affected by it. It's just both numbers go up and down at the same time. Doesn't really matter. More importantly, is that when business is tougher, whatever that word means, it doesn't per se affect the value of collateral. Even if it affects the profitability of a borrower, even if it affects the life of a borrower. In secured lending, one-off secured lending, which is available to anybody with capital, one-off secured lending, the collateral will control the outcome. And if you simply manage collateral, the borrower doesn't matter because you have collateral. And one last comment. The topic of our presentation, Howard, relates to credit strategies. Credit. Credit is an interesting word because it comes from the Latin to trust or to believe. And neither is true in the extension of credit. If you trust or if you believe, you're probably doing something wrong. If you're a secured lender, you neither trust nor believe, you know. So in secured lending, I know precisely what the risks are, and I can remain pretty immune to externalities.
But Bob, can I ask a question? Because you made a
Sure.
comment about collateral. The value of that collateral can collapse.
Actually, not really. It doesn't collapse. If you understand collateral to be accounts receivable, inventory, perhaps IP, but not really, and equipment, it might decline a bit. But lenders never lend at 100% of value. They lend at a percentage of value. So there's no such thing as bad collateral, only bad advance rates. And that becomes understanding the collateral. It's there are subprime
Bob,
lenders who lend
can I
against
take a step back?
garbage, but at a low enough rate, they can't get hurt. So collateral values are simply what a secured lender is in control of. Externalities, I'm not in control of anything. I can control the advance rate against collateral. So I'm a control freak. I like to be able to not worry about what's going on in the world, just worry about not having a bad day.
Bob, can I take a step back and a little
Sure.
bigger picture?
Take lots of step backs.
So secured, unsecured. Those are words. And to Suzanne's point, the underlying collateral. But and somebody brought up bank loans. So I want to also separate that out. Okay, is that whether it's high yield or senior secured loans, banks underwrite and sell them, but the borrower is a company in all of those cases at least. Okay. So it's only a bank loan when the bank holds it on their balance sheet or the bank actually issues their own thing. So things that are issued by banks are companies like Dell Computer, senior secured loans, or a lower company selling high yield debt, formerly called junk bonds. So the banks are simply the sellers of all that stuff. That's it. You don't owe your money to a bank. So don't confuse the two things. And that's all the GFC crisis and all that was banks' balance sheets. So, but I want to make one important point. There are times when unsecured debt has such a higher return that it's worth doing. And I was just on a call, a small group with Apollo's head of credit, John Zito. So I'm going to quote him instead of me saying it. And he goes, somebody goes, what are you guys doing today? He goes, today, the game has changed. He goes, 5, 8 years ago, unsecured debt was fine. This is because the default rates were low. The recovery rates, by the way, are also low because there's no collateral, but still it pays. But he said, is this environment, we are moving everything to secured debt. He goes, there's floating rate secured debt and there's fixed rate secured bonds. So, but the collateral on a floating rate loan from Dell Computer isn't a house. It's all the assets of the company Dell. So they literally have to liquidate because you're the senior secured lender, excuse me. So you are the top of the thing. The equity has to get wiped out and the entire company literally has to go into liquidation. And by the way, the recovery rate, this is important. I want to get to that topic on whether it's direct lending or anything else. The recovery rate of senior secured is about 80% north of that. The recovery rate of junk bonds, high yield, I'm supposed to stop calling them that, is about 20% because they can be restructured and there's sometimes something there.
I have a comment to make, and Bob, just give me a second here. So, and I think the difference here is that we've got hedge fund guys on one side and Bob, who's probably like one of the leading lending guys in Los Angeles. And the hedge fund guys look at it from I think, was it Loris who went under back in 2008? I forget the name of there was like a hedge fund that went from like $1 billion to 5 billion and all their collateral just dropped through the floor. Loris, was that the name of the firm? It was a bunch of Russian guys. They had started this firm. They used to be on 45th Street in Roosevelt, and they just
Not
crashed.
ringing a
I
bell.
talked to 2,000 hedge funds, never heard of them, but.
Yeah,
maybe
me
it's a correct
neither.
name.
No, there was a large hedge fund that crashed in 2008
There
in
was
the
quite a
credit
few.
There were
markets.
quite a few, yeah.
Right. In the credit market, they were doing asset and all the assets. They had inflated the asset
There were
values.
structured products, there were
Yeah,
convertible.
and
bonds,
so I think
they
that
all
Bob
went up.
comes in it more from, he's as he already said, AR, inventory, et cetera, right? So it's a little bit of a different animal, maybe.
Well, let
I think
let
the
Bob
advantage that-
explain what Bob,
Okay,
when
Bob.
we use the word collateral, it would be helpful if we distinguish between two uses of the word. It's my dichotomy. It's not a formal dichotomy. Economic collateral and legal collateral. Legal collateral is a loan is made and the lender takes a lien on all assets. That was mentioned a second ago. In that case, the loan is not contractually linked to the collateral. The lender says, I have collateral, and the lender makes the loan. But the lender does not worry about, is the collateral more than or less than the loan? It's just not part of the credit consideration because the primary loan is against cash flow. In asset-based lending, which is my world in all of its permutations, the loan is always linked to collateral. Collateral goes down, the loan goes down. So those loans are economically secured. And unless the lender made a mistake or was defrauded, the two things that can go wrong, unless the lender made a mistake or was defrauded, the collateral will be worth more than the loan. And therefore, what happens to the borrower is kind of irrelevant. You lose a borrower, but you don't lose any capital for the most part. Now, that's overly simplistic, but that'll distinguish in this conversation when we
So-
use the term collateral.
So Bob, let's talk about underwriting then, okay? Because we might be hedge fund guys, but had 30 strategies of specialty finance. Some like trade finance is secured by assets. Others like litigation finance is not. Okay, so, but let's talk about underwriting and recovery. Because the one thing, the last panel was private equity. Equity people want to figure out how much money they can make. Credit people want to figure out how they get paid back. There's a really different mindset to that.
I agree
let
with
me-
that. I agree with that.
So
well,
I just want to finish
okay.
the one thought and then go for it.
You don't need
So, so, so the thing here is if you are an investor, you're a family office investor and you're investing in a fund or somebody, whoever that's doing loans, okay? There's two key components to getting paid back, okay? The quality of the underwriting to begin with and the discipline of that. That means making sure that to the best of your ability, this loan is as good as it's going to get, okay? The second part is recovery because all those specialty finance funds are not usually defined by how much they can make on the loan. They're defined by how they recover bad loans because that will happen. You do this long enough, you will have bad loans. Okay, even in senior secured syndicated loans, the default rate's only 1%, but there are bad loans. So the recovery rate of the funds I invested in was based on a lot of expertise, hard work. Did they spend the money to do good underwriting? Did they spend the money? Do they have you're a lawyer? Do they have a legal team to do a good recovery process? And in the long term, you as an investor in lending, that's going to define your returns, underwriting and recovery.
I couldn't tell if that was a question.
Say again?
I couldn't tell if you were posing a question or simply making an observation. Sorry.
No, I was making a statement and I was making what you said and turning it into a broader sort of across the board thing that anyone can apply to anything they're investing in when it comes to lending.
I just
Let
have
me-
one comment on, I'm sorry, Suzanne, just one quick comment in response. In, um, in one-off credits, we are talking about loans probably between $500,000 and 10 million. That's kind of the world that I live in. It's a world that I understand and love because I spent all my life avoiding competition. I find competition to be exhausting and expensive. And I look for areas where they are underserved and I can serve them. And in this market that I've described, the family offices that I've spoken to don't even know that it exists, let alone it's underserved, and how easy it is to get into it and easy it is to get out of it. So the purpose of this session, as I understand it, is just to introduce conceptually that area of employment of funds. We're not talking about appreciation of capital. We're simply talking about returns that are disproportionately high to the risk. And then you mentioned unsecured lending had higher than usual rates. I agree, but they're still infinitely lower than other forms of lending. They are
I said
higher than they
sometimes,
used to
sometimes.
be.
But I have one
just wanted
question
to-
for you.
Wait, sorry, I want
I
to
have a
just
question too, but Suzanne goes
I
first.
really want to differentiate like the conversation a little bit because I come from a little bit of a different world. You know, Claren Road, for example, was a long, short, liquid credit shop. We were not doing direct lending. We were not worried about collateral. We were investing in public securities. Now, what I will say to Andy's point earlier is we were really good at picking credits, long and short. And we had a client come to us and say, "You're so good at picking individual names, you guys should start a long, short equity fund." And I remember Brian Riano saying, "You don't understand. Equity people are glass half full people. Credit people are glass half empty people." And that's what you have to remember because equity, you can lose everything and you can make a lot more. Credit, you're looking only at the downside. So, and just to finish, and what we do at Lampe Conway is also different because we're trying to invest in the existing public security. We're looking for equity-like returns with credit-like risk. And that's a different kind of underwriting.
Yeah, so let's change gears and off the underwriting and stuff. And I don't know, Robert's talking about a very, very specific strategy. But the other side of credit is equity-like. It's buying banged up, damaged, tinted. It's buying bad credits and then restructuring them, recapitalizing them, because the lender's in trouble. That's how the credit got in trouble. And you go in there and you're buying something at 20 cents on the dollar that was supposed to be 100 cents on the dollar. And now you are in control of certain things that happen because you're the lender. And lenders, unlike equity, are senior. So the equity people have nothing to say. This is what Suzanne's talking about, but the credit people do. So the other side of underwriting and recovery is to literally go in on purpose. So this is my fourth aircraft lending cycle. They're in cycles. Okay, we literally bought. They're called EETCs. They're aircraft lending things that were busted. We took 6 airplanes physically and had somebody in the desert take them apart, sell the engines, and made money. This was in a fund of hedge funds, believe it or not. I mean, we had a little bit of illiquidity thing. So I'm giving you the extreme example, but there are much, much more common examples of debt restructurings. And Marty's got something.
I just have a question for Bob again. So, and Bob, I just want to, the banks have pulled back from lending. There's a lot of people who have private businesses who are looking for loans. And I think that's an area that you get involved in. So if you could just give a case study, something that you've seen, that you've looked at recently or done, number one. And then the second thing I want to talk about, Bob, is that many years ago, you told me there's no such thing as subprime loans. There's only poorly underwritten loans. Can you expound on that?
Of course. Well, I have 3 comments. Suzanne, don't be self-conscious as to being, you come from a different world. You come from the world you're surrounded by people in your world. If you want to know somebody who comes from a different world, it's me. I'm
Well, I
the
don't know.
guy asking,
I know other people who do what you do. I've looked at
and
enough
then
We've
management.
as to
invested, and we've invested in people like
I
you.
mean, we've invested in people who do what you do. So
and by the way, one of the
just
first
what I
loans.
do is different.
Sorry, Suzanne. One of the first loans I did was to a potter, somebody who bought those parts in the desert and made loans to him. It was one of the I did that loan in about 2002. I didn't even know there was a word for it. He was called a potter, Parter, and he did exactly what you said. And I provided the financing because it made sense to me. And as to the question about there are no bad collateral, and you mentioned buying
What they're saying, what you
distressed
said,
debt.
Bob, 10 years ago, you said there's no such thing as a subprime loan. There's only poorly underwritten loans.
Of course, because a subprime loan is worth more than zero. That's clear. It's not worth as much as a prime loan. So long as you lend a percentage of its diminished value, but your percentage is intelligent, you're going to get all your money back. So it's not bad collateral. Any collateral can be good if you don't over advance against it. That's the point, and that's what an underwriter does. And as to the buying distressed debt, you're exactly right. That's a great marketplace. Now, I don't like to have employees. I
Fortunately,
don't like
there's
to have
not enough
people.
of it right now.
And well, but what I do is, if somebody is buying distressed debt, I'm not going to buy the distressed debt because it's too much work. I'm going to lend to the buyer of
It's a lot of
distressed
work.
debt. I'll put up 80% of the money and I'll buy your intellectual ability and I'll give you a little bit more of the profit. And I'm just putting up the money. And that's what asset-based lending is.
So a subprime loan, quite simply, to Marty's question and your point, is a poorly underwritten loan that the world doesn't think it's worth 100 cents on the dollar. That's what a subprime loan is. Now, in the great financial crisis,
On
I got
day
washed
one.
away. Well, yeah, on day one, a poorly underwritten loan. Okay, so now that should have an excess return. And I said sometimes, I didn't say, forever. That could be an attraction. Now, after all that got washed away, you know what happened in 2009? Mortgages were cheap, the garbage was gone, and we actually went long mortgages, unlevered, just straight, they're called pass-throughs, just portfolios of loans, re-underwritten, by the way. So we knew what they were in 09, not what they were back before. And that fund we invested in was up 91% on boring mortgages. No leverage, no structure, no nothing. So markets aren't efficient. They're not efficient. And so there are times, and what Robert's doing, and he can correct me, he's avoiding the market. He's going where people are not, and he's controlling each situation one at a time. And we invest in people like that, but that's not the whole world.
So Bob, one of the things that you said when we spoke is that, which I thought was very interesting, is that you're not replicable.
No, what I said is it's not really the businesses that do it are not scalable in the way that you guys think about it, only because it requires a skill set that can't be done by a machine. Some of the feedback can be, but it's one-off, old-fashioned lending. It's intellectual lending. You have to know how to do it and learn it from somebody. And the fact that at the bottom or the top of the pyramid, however you draw it, is a human being exercising wisdom. But the point is, the amount of time it takes to underwrite a secured loan is remarkably low. It's kind of easy if the collateral is understandable. It's not very hard to do once you learn the secret sauce. So in a way, it is scalable because it's not that hard to do. And the only thing I hope to accomplish in this session, in the few minutes we have, is to give exposure to a segment of the credit market that is underserved, kind of invisible, and family offices can get into it with almost no effort, and they could leave it with almost no effort, and along the way enjoy mid-teen interest rate returns that are not replicable in the market at large. No capital
I
appreciation,
would,
but a high return.
I wouldn't say it's not replicable at the market at large. I would say the market is just very fragmented for what you do, because one person or you can only underwrite so many loans, but there's a lot of companies out there to be underwritten. So I think it's just a very fragmented market, which makes your job easier in a way. But there are other guys out there.
And Bob, what's your opinion? I'm gonna make a statement, but I want your opinion. So you just said if the collateral's easy to understand. Okay, that was something you said. So so if Dell Corporation, we all know who they are, okay? It's actually a private company, not a public one. If Dell Corporation issues a senior secured floating rate loan that's collateralized by everything in Dell, and I can tell you what that is, I don't have a list. What do you think of that as a simple version of understanding collateral? What do you think of that?
It's so much above my pay grade. It's so much not what I do. It's like asking me about advanced orthodontia. I mean, I have no idea. It's not what I do. It's not what I would like. If I had to do that, I would quit my job.
Fair
I
enough.
don't like it.
Fair enough. I just asked your opinion and it's all right. Fair enough.
I understand everything I do intellectually.
There's about 8
I
minutes.
just wanted to make one comment on the parter. People
Potter,
who
yeah, the
sell
guy
parts
who
of
buys
airplanes, et
planes in
cetera.
the airport, in the
Yeah,
desert.
yeah. In the Bronx, we call it chop shops.
That's right. That was one of my first frauds,
Creation
a
was
chop
bought by
shop.
Carlisle, by the way.
Was that?
I was on a cruise in 1971 with a guy who ran a chop shop in the Bronx. I
There
remember
you
that.
go.
Yeah, on my honeymoon.
Suzanne, one of the questions I wanted to ask you is, which sectors do you find most attractive now? And you can all answer this.
What section? You go first.
So I'll give you two versions because there's the closer to what Bob does version and the bigger picture version. So there's a lot of uncertainty in the market. You know, markets don't like uncertainty for a reason. And so that was, we started out with going to secured and getting rid of unsecured. Okay, that was just basically, but that's not a sector. Okay. The other thing was, and I'll quote another big hedge fund manager, but these people aren't dumb. They run $60 billion. And
That doesn't mean they're smart.
no, but
okay, it could mean they're good marketers.
no, it's Steve Tannenbaum, and I've known him since 2001.
Okay,
He's a smart guy.
he's a smart guy.
So what he was saying was, he goes, when all the tariff noise was there, all the loans went down, all of them, they all went down. He said, so we went in and we bought domestic telecom companies loans, T-Mobile, think of, okay? And so his argument was that they're pretty much not exposed to tariffs. So whatever happens with tariffs, T-Mobile versus, let's say, I don't know, Amazon or Walmart, you make up whatever the tariff stories are in the news, which doesn't mean anything, but it's because news. But it's not hard to imagine that T-Mobile has less risk to tariffs than Walmart. That's easy to imagine. But they all went down. So he goes, well, we just sold this and we bought that. So that's one side. So the other side is more to Bob's end, specialty finance. Okay, so there are certain things that are less economically dependent. They could be short-term real estate bridge financing. Maybe it's a little closer to what he does. That's secured by real estate, but we're not secured by real estate for 25 years. We're secured by real estate for 6 months. Okay, so the visibility to getting repaid has brought much, much closer to the present. The flip side, my last example, would be something like reinsurance. Okay, which I don't get into the complexities of it. We invested in it, but there's no tariff effect of that. It's hurricanes, fires, and earthquakes. It's not tariff related either. So, and that's a cyclical market as well.
So I would agree with Andy, on real estate lending, but particularly going in where there's a clean balance sheet that the manager has, because you don't want to be buying old loans that they've made. And also, to your point, I like guys who are doing short-term financing in real estate on very high quality assets. And Jeff Asaf made the point this morning that these higher interest rate loans that need to be made for these kinds of deals, there's a push-pull, right? The guy who made the loan wants you to keep the loan. The guy who took the loan wants to pay it back as soon as possible because it's expensive. So the capital gets to turn over. So I like that. I like our space because I think that, again, to my,
What it is.
I did, weren't you listening?
I was listening.
You
We're,
two should go on the road.
Person.
as I mentioned before, we are lower middle market, special sits and event driven. We like credit, to begin with. We'll do stressed equity, but our core business is to look at a company's existing capital structure. And these are small companies, usually sub $500 million in enterprise value, figure out what we think the fulcrum is, want something bad to happen, and then work with the company and restructure the loan. And we don't take control positions. We like to take blocking positions in the issue, because when you take a control position, you're restricted. And now you could be in a roach motel, right? If you go on a committee and the next day you discover fraud, you've got a problem. If you're in a blocking position and you can work with the other creditors in the group, that's I think a good place to be. The last thing I'll say that I like, and I think hedge funds, as we all know, have been out of vogue, and I would also say long short equity, but this is a credit panel. I like long short credit. Guys who can
I agree.
take advantage of the volatility in the markets, and that are liquid. And there's some good guys out there.
So let me explain a little bit of why I think what Suzanne said. So 7 years ago,
He's doing my job for me.
7 years, well, I'm just on the others, I'm always on the other side of the table, but sometimes you should see us fight. That's wonderful. We've had a few of those. Anyway, so 7 years ago, and one of the reasons I left the institutional world was there were no defaults. There were no bad loans. Even companies literally going into bankruptcy got refinanced. Like everything got refinanced. So the strategy that Suzanne's talking about, the opportunity set was almost not there.
Well, that's why my partners wound their fund down and
Yeah,
became a
okay.
family office, because
Perfect.
the opportunity wasn't there.
But today, the CEO of this woman at the trust company in the West said their biggest business right now is rescue finance. So that's not middle market. That's big stuff. So the point is, today, what Suzanne's talking about is a whole new opportunity set, because
It's finally timely
Yeah.
again, which is why we're in the market.
right. And hedge funds are good at that. They are good at that. I ran a credit
Howard-
fund of hedge funds for 15 years.
Yes.
Howard, one observation. Andy, a second ago, you said as part of your presentation, there's a lot of uncertainty in the market. And I was smiling to myself, maybe you heard me smile, because in my world, to show you, Suzanne, I'm the stranger in the group. I'm not ever aware of uncertainty in the world, nor does it affect what I do very much. I have my collateral. As I said at the beginning of my remarks, if you do it right, you're kind of immune to externalities, and you're in control of your life. The risks you have are, for the most part, within your control. In 2008 and 2009, I was doing lending for 8 years. It was the best year I ever had. There was profound uncertainty. I loved it. It was like the cash register was clicking, couldn't stop.
So Bob, by the way, the global financial crisis didn't start in 08. It started in 07. There was a credit crisis in 07. So when you say it doesn't matter, I'm going to disagree, not for your business, but for the principle of it, is that what happened was collateral damage. The credit things that collapsed had knock-on effects, that had more knock-on effects, that eventually ended up literally going around the planet. And
That was because of leverage in the system too, because it was so huge.
My point is, yeah, you're correct, but my point isn't why. My point is things are happening somewhere and you are not isolated from big things that happen just because you're drilling down into your little. I don't
That's
mean
why you advance
I'm the
percentage
principle.
of the collateral, not the full value, because the percentage you don't advance is the cushion, because it's never all or nothing. It's just collateral is worth less. Yes, you may have losses. All of that is built into the rate. The rates are too high for the risk. They're wonderful.
But the thing is that you would say to any lender, what happens if you end up owning the asset?
Never happens. You sell it. You don't, if you end up owning it, you're doing something wrong. You sell it.
Is there a question over
This
there?
is last question.
Robert, tell me, on the collateralized loan, the collateral portion that go bad, the loans that go bad, what is the percentage that you recover? Because in those situations, you're dealing with a valuation of the asset that you should have taken in advance before you made the loan, so you know what the value is on a going concern basis. On a distress basis, you have a different, what percentage of that value do you get back against the loan?
Understand,
Well,
well,
typically.
yeah, there's no such thing, because if a loan goes bad because of a fraud, everything's off the table. You should have caught it. It's on you. You took a hit, and you say never again. So
But
you
you
have
still
to
own the
take frauds
collateral.
off the
Fantastic.
table.
The collateral.
Great answer.